Welcome to the deep dive. Today we are taking a really focused look at something that's, well, it's volatile, complex, and honestly sometimes just baffling: cryptocurrency. Our mission here, it's pretty critical. We want to give you a kind of rapid guide,
Mhm.
a set of clear fundamentals, the stuff you need to actually evaluate these investments accurately. And maybe most importantly, tell the difference between a genuine project with potential and some of the elaborate scams out there, because they definitely lurk. We have this core belief, and it really guides everything. Hype dies, fast fundamentals last. If you want to survive a downturn, a crypto winter, understanding those foundations, that's everything.
That focus is spot on. It's essential because crypto, just by its nature, it's newer, it's global, and it's way less regulated than, say, stocks or bonds. At its heart, what is it? It's digital currency, right? Protected by cryptography. And the foundation everyone talks about is the blockchain. Think of it like a shared, tamper-resistant digital ledger for transactions. NIST, the National Institute of Standards and Technology, they emphasize it's decentralized. So no single boss in charge.
Okay, so decentralization, that's the big promise. But you mentioned risk earlier. If the crypto itself is locked down with encryption, where's the weak spot?
It's usually in the implementation, not the core crypto math itself. Even with strong cryptography, you can still have vulnerabilities, maybe in the smart contracts that run on the blockchain or the websites, the wallets, even the human element, the team running it. That can lead to hacks, unauthorized access, manipulation, which is why it's still seen as inherently high risk despite all the clever tech.
Right, okay, so it's messy. We need some structure then to cut through the noise and the risk. How do we as learners trying to be informed start picking apart a project? What's step one?
We can definitely streamline it. I think focusing on four main pillars really helps. First, you absolutely have to study the project's white paper, then do some serious digging on the development team. After that, carefully examine the tokenomics, the economics of the token. And finally, you need to look at the bigger picture, market trends and overall sentiment. Those four together. That's your key for assessing potential and long-term stability.
Okay, let's unpack that, starting right at the beginning. The project's blueprint, the white paper. Seems like the obvious place to start. In traditional business, yeah, it's the business plan, but for crypto, it feels like the demands are, well, higher somehow. A good white paper, it needs to clearly lay out the purpose, the goals, the tech underneath, specifically what the blockchain does, and crucially, explain the token's utility. Like, what problem does this actually solve? How does it improve things?
Exactly. And, the difference in quality you see here is just massive between a legit project and something purely speculative. Real white papers, they don't read like slick marketing flyers. They're technical, often dense, maybe well cited with proofs, and they clearly explain the mechanics of how the protocol works. If you pick one up and it's all just vague enthusiasm and zero technical detail, that's not really a white paper. That's more like a red flag dressed up as a vision doc.
Okay. Can you give an example of a good one versus not so good?
Sure. Look at Chainlink. Its white paper is really detailed. It explains their decentralized Oracle networks, how they securely connect smart contracts to, real-world data feeds. It's complex, but it's thorough.
Right, technical depth.
Then you have the complete opposite, something like Peepcoin. There's no real white paper. It's basically a fun website that even says, look, this has no intrinsic value. But through memes and hype, it hit a market cap near $50 million early last year.
Wow.
Yeah. Tells you hype can create temporary value, but there's nothing fundamental holding it up.
That contrast is stark. Really shows why the technical foundation matters. Okay, let's shift gears then. Let's talk about the people, the development team. Why should we care so much about the team? Isn't the code the important part?
Well, yes, but who writes the code? Who maintains it? Who adapts it?
Right.
Especially in crypto, where projects can pop up anonymously and regulation is still, catching up. The team is just as vital to check as the management of a public company. Legit projects, the ones aiming for the long haul. They want you to know who they are. They show off their team, their past experience, their blockchain expertise, their track record. Exactly. You're basically investing in their competence and their accountability. Think about Polygon. It's a major project, right? They have detailed team profiles. You can see past roles, relevant experience in tech. That transparency builds trust, especially with bigger investors.
And when that transparency is missing, that's when the alarm bells should ring, I guess. Any examples where that risk blew up?
Oh, definitely. The classic painful one is the Squid Game token.
Ah, yes, I remember that.
It was anonymous right from the start. It just piggybacked on the massive hype of the Netflix show, no credible history for anyone involved. And predictably, it turned out to be a total fraud. A classic rug pull became worthless almost overnight. It really proves that anonymity, especially when combined with borrowing someone else's brand for a quick buck, that's just a massively high-risk situation.
Yeah, a tough lesson in due diligence. So for you listening, the takeaway is clear. Check those LinkedIn profiles. Look at official websites. Verify project histories. Transparency and a proven expertise. Good signs. Anonymity or fuzzy histories. Big risk signals. Okay, so if the team is the human proof, what about the crowd, the community? This is where it gets really interesting, I think. Because beyond the docs and the team bios, having a strong, genuinely engaged community feels like another really important sign of legitimacy, doesn't it?
Oh, absolutely. It acts as social proof, for one, but it's also like a decentralized quality check. An authentic crypto community, they're talking openly about technical progress. They suggest improvements. They push the team for transparency on updates, problems, the roadmap. Think about Ethereum's community. It's huge and vibrant. People are constantly discussing network upgrades, tech stuff on Discord, on Reddit. The focus is on development, sustainability, evolution. Compare that to scammy projects. There, the community discussion is usually just aggressive promotion, hype, price predictions, very little real technical talk.
So you need to actually join those channels, look past the to-the-moon memes, and see if there's real substance being discussed.
Exactly. Is it about building something or just pumping the price? Big difference.
Right. Okay, community is social proof. Then let's get to the numbers, the core math.
Yeah.
Tokenomics. How do we start breaking down how a crypto asset actually creates and holds value?
Yeah, tokenomics is key. We usually start with supply. How many tokens are there? How many will there ever be? This is all about scarcity. So you look at circulating supply, what's out there now, total supply, including locked tokens, and maximum supply, the absolute hard cap, if there is one.
Okay.
But really, for long-term thinking, you need to look closely at the token emission rate. That's how quickly new coins get released into the market.
Why is that rate so critical?
Because it controls inflation within that specific crypto's ecosystem. If too many coins flood the market too quickly, it dilutes the value for everyone already holding them. A good model often has a decreasing emission schedule over time.
Like Bitcoin.
Bitcoin's the gold standard example, yeah. Fixed limit, 21 million coins, period. And its emission rate gets cut in half roughly every 4 years, the halving. That predictable decreasing supply, that built-in scarcity. It's a huge reason why its value has generally trended up long-term, despite all the crazy short-term swings.
Okay, so supply and emission rate, then there's how the tokens get out there in the first place, right? Distribution.
Exactly. Distribution methods. Was it mined, staked, airdropped, sold in an ICO, initial coin offering? The key thing here is concentration. Is the supply widely distributed, or are just a few wallets holding almost everything?
And if it's concentrated.
Big risk of manipulation. If a tiny group holds, say, 80% of the tokens, they can crash the market whenever they want by selling. Wider distribution generally means more stability.
Makes sense. And the last piece of tokenomics, utility. What the token actually does, I've heard people argue utility can be a bit overrated, especially if the only use is paying network fees. Doesn't that just make the token's value dependent on network traffic, not something intrinsic? Is that a weakness?
That's a really fair point and a good critique. If a token is only for paying transaction fees, its value can definitely be precarious, tied entirely to network adoption, like you said. But strong utility is usually multifaceted. Tokens used for essential functions tend to hold value better. Think about things like governance, using the token to vote on the project's future, or staking rewards, locking up tokens to help secure the network and earning more tokens back, or being the main currency for smart contracts on that platform.
Okay, so layers of utility.
Exactly. Ethereum's Ether is a great example. Yes, it's used for gas fees, but it's also staked to secure the network, earning rewards. And it's the fundamental currency for countless DeFi apps and NFTs built on Ethereum, that indispensable multi-layered role. That contributes massively to its, $200 billion plus market cap? It's deeply embedded.
Right. Let's zoom out a bit now. We've talked about evaluating the project itself, but what about the playground it lives in, the market environment? We have to touch on volatility.
Oh, absolutely. Yeah. The crypto markets are famously volatile, unforgivingly so sometimes. They react instantly to regulatory news, shifts in investor mood, geopolitical stuff, global economic changes, you name it. And adding to the intensity, trading is global, 2047. Never closes. There are no circuit breakers like in traditional stock markets to pause panic selling.
Non-stop action.
Perpetual motion, yeah. And that, plus the regulatory gray areas, is why bodies like the SEC constantly warn that these are exceptionally volatile and speculative investments. It's not just cautious advice, it's a statement of fact about the risk level.
And we see investors trying to navigate this chaos with different tools, right? Some use fundamental analysis, looking at that intrinsic value we talked about. Others use technical analysis, studying price charts and patterns. And then there are market sentiment tools, like the Fear and Greed Index, trying to gauge the emotional state of the market.
That's right. And another huge factor now is institutional influence. And this has really changed the game in recent years. Big players, institutional investors, they're coming into crypto mainly through things like ETFs, exchange-traded funds, and futures contracts.
Does that help or hurt?
Bit of both, really. Their presence adds a lot of liquidity, which can sometimes stabilize prices, but it also means large, sudden market moves can happen when these big players decide to buy or sell huge amounts.
So, okay, you've done your homework on the white paper, the team, the tokenomics, the market. You're thinking about investing. What does all this mean when you're actually about to click buy? It sounds like vigilance becomes priority number one, because you have to dodge the scams hiding among the real projects. Let's start with that chilling term, exit liquidity. What is that exactly?
Exit liquidity is? Well, it's the moment the scammers are waiting for. It's when the insiders, the developers, or very early investors who got tokens for virtually nothing. They wait until enough regular folks, retail investors like you, have bought in, enough to create a market where they can sell. As soon as there's enough cash floating around in the trading pool, they dump all their holdings at once, sell everything, they exit.
And the project collapses.
Instantly, they abandon it, take the money, and run. The regular investors are left holding basically worthless tokens because there's no liquidity left to sell them into.
That's terrifying, and it brings us back to why those security checks are so vital.
Absolutely non-negotiable. Any serious, legitimate project must have things like external security audits from reputable firms. They should have bug bounty programs paying ethical hackers to find flaws. And ideally, shared control systems like multi-signature wallets for the project's treasury. So no single person can just drain the funds.
And if a project resists that, if they say audits are too expensive or not needed,
That's not just a red flag, that's a giant blaring siren. Get out. Seriously, resistance to transparency, especially on security. Major warning sign.
we hear about common scams like pump and dumps artificially inflating the price through hype, then selling off. And rug pulls, like you described. You mentioned a specific one, Froggy Coin in 2024.
Yeah, Froggy Coin was a pretty textbook rug pull, and fast. The developers built up a ton of hype on social media, got people excited, pulled in investment. Then, once the pot was big enough, they just drained the liquidity pool, swapped all the valuable assets paired with Froggy Coin out, crashed the price to zero instantly, investors couldn't sell, game over.
Wow. But the threats now are getting even trickier, aren't they? Going beyond just hype.
They really are. A particularly nasty emerging threat is the use of generative AI. Scammers are creating deepfake videos, highly realistic fakes of famous people, think Elon Musk, or well-known financial gurus seemingly endorsing a scam coin.
Oh, wow. I've seen some examples. They can be really convincing.
Disturbingly so. They're not grainy fakes anymore. These are sophisticated campaigns designed to build instant credibility and trick people fast. Combine that with these aggressive, anonymous schemes, and also those horrible, slow-burn pig butchering scams where they groom victims over time. All of it led to record levels of crypto scam losses reported in 2024. The tech is being weaponized to make scams look real.
That move towards deepfakes and advanced tactics just underscores why practical, personal security measures are absolutely essential, not optional.
Couldn't agree more. Essential. Number one, use hardware wallets for any significant amount of crypto. These are physical devices that keep your private keys, your access keys completely offline, away from hackers.
Okay, hardware wallets. What else?
Enable two-factor authentication, 2FA, everywhere. On exchanges, on email, everywhere. And use authenticator apps like Google Authenticator or Authy, not just text messages, which are less secure. If you have larger holdings, consider multi-signature wallets. These require multiple approvals, maybe from your phone, your computer, a hardware key before a transaction can happen. Spreads the risk. Prevents a single point of failure.
Good tip.
And finally, just basic digital hygiene, but super important here. Be incredibly skeptical of unsolicited messages, emails, links. Verify sources. Phishing attacks are rampant. Oh, and use a trusted VPN, a virtual private network, especially if you're accessing accounts on public Wi-Fi.
Right. Solid advice. Okay, let's try and bring this all together. We've covered a lot. The bottom line for this deep dive seems to be evaluating crypto isn't simple. It's a mix. You need technical analysis skills, fundamental research chops, and a very, very healthy dose of risk assessment. So recapping those key steps for everyone listening, you've got to read that white paper, look for real technical depth. You have to vet the team, check their track record for accountability. You need to analyze the community. Is it genuine engagement or just hype? Assess the tokenomics, the supply, distribution, and especially the utility. And stay plugged into market trends and the evolving regulatory picture.
That's a great summary. And maybe one final thought to leave people with, especially building on that security discussion. Since scams are getting so much more sophisticated using AI, deepfakes, all that, the really critical question for a serious investor isn't just, is this project secure now? It's shifting. You have to start asking, how well is this project's security designed to withstand threats that haven't even been invented yet?
Wow. Future-proofing security.
Exactly. That kind of forward-looking resilience, that's likely going to be the defining challenge, maybe the defining feature of the next wave of successful, sustainable digital assets. It demands ongoing diligence, not just a one-time check.